Good afternoon. Thank you very much, everybody who's joined us today. What should be a deeply relevant and timely discussion. By way of introduction, my name is Philip Bahoshi. I'm the founder and CEO of Magnet, a private capital data platform covering emerging markets, including Africa, the Middle East, and Southeast Asia. And that's provided us this front row seat to what has been happening in the venture space across these types of markets, and specifically the challenges of liquidity, exits, and market cycles. I'm delighted to be able to be joined today by Professor Claudia Zeisberger, Senior Affiliate Professor of Entrepreneurship and Family Enterprise at INSEAD, and in my opinion, one of the leading voices of private equity and venture capital. Not only does she do that in an academic capacity, but if you haven't signed up to her YouTube, you should. She shares lots of insights and intelligence on the evolving space. She's also been coming regularly to the part of the world that I'm in. So I'm currently here in Dubai, but the Middle East, shaping the discussions of what's happening in private equity and venture in the kingdom. And from my opinion, we're at a pivotal moment for private capital. Public markets are soaring. We're looking at equity indices at record highs. We've seen historic levels for gold, and we're all waiting to see and anticipate what will be happening with the Fed in the US. But in contrast, private markets have been catching their breath from what has been a bit of a slowdown in the last 2 to 3 years. Venture capital since 2021's peak has seen 2 to 3 years of decline and only slightly picking up now. Private equity is lacking lots of exits. Private credit, on the other hand, extremely popular, but we're seeing rising default rates, and infrastructure and real estate has remained resilient. So today's session is the liquidity paradox, the search for exit in private capital, and we'll be discussing this dynamic. The aim is to have many thought-provoking conversations around this, but to really kick this off, I'd like to pass on the stage to Claudia, who will share some of the latest insights from her perspective before we dive into a Q&A session. So over to you, Claudia.
Fantastic. Thank you so much, Philip. Always a pleasure to be together in the room with you, for now virtually, but soon actually in person. So hello, everyone. I understand we have record signups. So thank you very much for making time wherever you are in the world. And I look forward to your questions. So now what we do, I will set the stage a little bit with a few slides just for context, so we're all aligned in terms of language, and to share a little bit what I have been seeing for the whole year basically. And I would say right now, secondaries in any shape or form, liquidity or rather the lack thereof, takes up about a third at least, if not half of my time in conversations with investors, family offices, pension plans, sovereign wealth funds, but also with GPs that are obviously reacting to the demand from the LPs. So allow me to quickly share this, and then we can get started straight away. So what I was asked to kind of talk about was path to exits across private capital, a liquidity paradox. And Philip obviously touched on quite a few verticals. So I will focus today on the private equity side. The private debt side is a complete different conversation. Yes, there are secondaries as well there, but that's a much longer webinar and we don't have that time. So meanwhile, please add your questions to the Q&A button below if you like to. And thank you to all of you that already shared the question when you signed yourself up for the webinar. Philip will help me manage that later on, but first, let's basically put this all into context. So private capital news. Yeah, what have we seen? This is just the last couple of months, literally. European GPs have raised record secondary funds. Secondaries are not just, as Philip rightly said, focused on the buyout side anymore. We are seeing now secondaries more and more on the venture capital side, which is interesting. And big investors are looking to kind of find paths to liquidity, which they haven't been receiving out of the natural kind of flywheel that the primary funds usually provide. Big conversations were around some of the American endowment vehicles. Yale basically had announced they wanted to sell up to 6 billion of their private equity portfolio. Those of you that were in my class will remember that Yale has one of the largest allocations to private capital already since the 1990s. So for them, actually, letting go 6 billion is quite a large number. And to my knowledge, they're pretty much done with that transaction as well. And then I stuck this one in. We just saw yesterday the founder of the Carlyle Group, David Rubenstein's family office, announced that they're actually diving really deep into secondaries as well. So again, I hear that from family offices and other investors as well. So that's literally life in private capital right now. Can't get away from secondaries. Now, quick recap. Primary funds usually are being raised for a 10-year time horizon. As you can see here, the J curve from the bottom left, 1 year to 10 years. You basically see for the first 5 years, deals are being made, capital is being drawn down from the investors, and we basically then see the private equity firm making efforts to create value in those portfolio companies and then find an exit again. So that uptick of the J curve, obviously, the faster it happens, the higher it goes, the better for the LPs, the happier the LPs. Happy LP, you will raise further funds in the future. LPs, limited partners, that means though all the investors in private capital funds. That's the primary side. Now, when this is not quite working, as I said right now, the flywheel is broken, enter secondaries. And secondaries, one good way to start thinking about it, and we will go into the different vehicles, but just conceptually right now, you can see here the secondary funds or secondary players usually play, call it between year 4 and year 8 of the primary funds. So as you can already see here on the J curve, what a secondary transaction basically does, it cuts off the left tail of the J curve. That means you are reducing your holding period. You do not have to necessarily hold for 10 years. Why? Because you're stepping into a deal at a much later point. Okay, so that obviously leads to faster path to liquidity, which right now is a big selling point for LPs. So that's just basically for context on secondaries. Now, DPI and TVPI. As one GP, an alumnus actually, recently said in my class, it's right now it's DPI or die as a private equity or a venture capital fund. DPI is basically a measure that private equity players are using distribution to paid in capital. So for all the money that I have invested in the fund, how much have I received back? Obviously, you want this to be above 1, okay? And once everything has been distributed, TVPI, total value to paid in capital, is basically your multiple that you're getting. Now, this is an interesting chart. As you can see, this is the percentage of funds that are loss-making in the different private capital buckets or verticals, if you like. So what's the percentage of funds that do not get into carry or do not get into at least returning 1x, one time the money that the investors invested? Obviously, venture capital being probably the most risky bucket in here, it's the highest percentage. Then we have real estate, growth equity around 20%, buyouts usually between 8 and 10%, a little bit higher here in that data set from 2025, private debt reasonably low. And then as you can see, secondaries, very few secondary funds do not at a minimum return 1x. Okay, so and when you start digging a little bit deeper, it's usually the ones that are doing secondaries in venture capital. So again, venture being the highest risk one. So keeping that in mind, that obviously makes it very attractive for investors, right? Now you may say, okay, if I buy a secondary stake in a fund, how much do I pay? Do I pay a discount? Do I pay a premium? And again, the discount or premium is measured to recent NAV, net asset value, the recent valuation, which in private capital is usually done quarterly. Now, in the context of my recent book, we actually kicked the tires on that and we looked into the last 2 decades. What's the average discount? And again, averages probably don't do the discussion justice, but let's go with it in the interest of time. It's about 14%. So think about a 14% discount to the last NAV if you need liquidity and you want to step out of a fund right now. So that's just basically as a rule of thumb. Now, let's go a little bit deeper. There are different types of secondaries, secondary transactions, LP-led secondaries or GP-led secondaries. And let's start off with the LP-led secondaries, because when I look back all the way to the 90s, where the original secondary funds were kind of created, it all started off with LP-led secondaries. Now, LP-led secondary, simple explanation. Again, I borrow the graphic from my recent book. So here's the GP. The GP has a primary fund. It's a limited partnership. That means he has existing LPs in it. Let's imagine it's year 4 of that fund. And one of the LPs needs out. This could be for reasons of portfolio allocation. So this may be an American buyout fund, and the LP has decided, I rather reduce my allocation to American buyouts and basically buy into growth equity in the Middle East or into a European buyout, right? So that LP will be looking for a buyer. The buyer will literally step into the shoes of the existing LP and will take on all the responsibilities, meaning future capital calls, if there still are some, but he will also compensate the selling LP for anything that he already has invested in the primary fund. So it's literally a transaction between 2 parties. Side note, the GP has to agree to the new buyer stepping in. So it's not quite like public equity. So far, so good. Now, this was very simple. One LP out, the other LP in. Now we can make this more complicated. And yes, there's basically, this is kind of the birth of structured products in private capital, do I dare to say it? But we can create much more tailored solutions. So let's say the LP, the selling LP, may actually want to get some liquidity, but may still want to retain some of the upside, the future upside in the fund. So you may actually create a little SPV where a special purpose vehicle, where the buying LP compensates the selling LP by paying a price, but the price will be a little bit lower. Why? Because for future upside, the selling LP still retains, let's say, 20% of future upside, right? I mean, we can get much more complicated on that. Now, let's leave the LP-led secondaries behind. That's very simple. LP out, new LP in. Let's have a look at continuation funds and strip sales, which are GP-led secondaries. Okay, so let's go with continuation funds. Right now, very fashionable. So now, this here, basically, we have an existing fund. The existing fund is a primary fund. And let's, for argument's sake, decide that we have in that existing fund, which may be in year 7 or 8, we have one asset that the GP really, really likes. They think that asset has tremendous upside. So what does the GP do? The GP sets up a continuation fund. It's a new fund, right? It offers existing LPs in the original primary fund the option. You can either roll, that means you can roll your stake into the new fund, become an LP in the new vehicle, or you can basically, what I call, take the money and run. So you can basically say, give me the price for that asset. You sell it to the continuation fund. For me, this becomes an exit. Right now, there are so few exits. I like to take the money and run. So far, so good. It gives liquidity to existing investors. You may then also, since not all LPs will be rolling, you may bring in some new investors. some new LPs. Okay. Right now, having spoken to a couple of secondary guys, given a choice, by far the minority of LPs will choose to roll. So anywhere, it was kind of a straw poll, anywhere between 60 and 80% of LPs will decide to take liquidity and go for the exit. That's a high number, but it shows you the desperation right now or the need for liquidity. Now, I'm going to touch on that just very briefly. Strip sales usually happens towards the end of a fund's life. And all we're doing here, we're not selling one asset. What we're doing, we're selling a share across a set of assets in the fund. So let's say we're selling 20% of portfolio company 1, 2, and 3 to a new buyer. So again, thereby creating liquidity for the existing LPs in the fund. So, like I said, we can get much more complicated, right? So now, what's the attraction for LPs, for investors that are new to private capital? So I'm sitting right now at my office at the campus in Singapore. So here in Asia, we have a lot of what I call startup family offices. That means family offices that are managing reasonably new wealth for a first or second generation family or a group of families. Now, quite a few of them are quite comfortable with public markets, but reasonably new to private markets. So does this offer an opportunity for them to enter private markets? Absolutely. Remember before on the J curve, it is actually quite attractive for newcomers to private market who are often shocked when they're being asked to lock up their money for 10 years in a primary fund. So secondary funds usually ask for 5 to 7 years of lockup, continuation vehicles, sometimes even lesser time. So again, there are basically all those conversations to be had. Clearly attractive, the secondary space, assuming it has the liquidity or you can find the products that you'd like to start your portfolio with. It clearly is attractive for first timers to private markets. So just simply because of the risk profile it has. Now, I mentioned venture solution on secondaries. So let me just basically spend 2 minutes on venture capital and secondaries, right? And there basically, let me start off by saying that venture, as Philip already alluded in the introduction, has had a tough time since 2021. And pretty much here is the one chart that tells the whole story. The peak here is 2021. It's 2021 basically, and that was the heyday of venture capital. This chart, I chose number of VC firms. I could have frankly chosen anything. Valuations, I could have chosen a fundraising chart. It would have been the same picture. Massive uptick until 2021, and since then it's been basically very dire with down rounds and so on. Now, what does that mean? That has led to some interesting product innovation. Number one, two sides of the coin, entrepreneurs and potential investors. For entrepreneurs, obviously with valuations dropping off, if you launched your company and you raised money in 2020, you've seen a really tough time potentially talking to your existing employees, keeping them on board until you can achieve liquidity. So the question basically, in the past, we've always seen public listing or acquisition as potential exit avenues for startup founders. As you can see, secondaries has bypassed public listing in terms of number of startups that achieve basically liquidity out of that. Now, drop in exit activity in late stage venture has basically asked, a lot of entrepreneurs have asked the question, are there solutions out there? So the GPs have started solutioning, for lack of a better word. So founders asking for cash, which is fair. I mean, not in your round A, but once you get to round C, D, and F, so they're asking for cash given their wealth is heavily locked up in the startup. So making them very often risk averse and not necessarily the best CEO anymore for the startup. So many founders, nevertheless, why they would like to take some cash off the table, would like to retain some upside. So the moment they sell secondaries, obviously the stakes are gone, right? You're selling your equity. So that's basically the conversation on the entrepreneur side. For the investor side, what have we seen? Now, investors see secondaries in VC actually as an opportunity from basically from family offices to sovereign wealth funds, all the way to corporate venture capital arms. Okay, they're saying, well, this may actually give us an opportunity to access those startups that we couldn't get the first time around, that we lost out on. So it may allow you also to backfill vintages. What I mean by that is if you're only investing in primary funds, we're sitting right now here in 2025, you can only invest in 2025 or 2026 vintage. Now, if you feel like you have gaps in your earlier vintages looking backwards, 2020 or 2021, why not basically do a secondary deal, fill in the gaps in your vintages and get them at a lower valuation, right? Remember the discount. So that would be one opportunity. And that is especially interesting for all the investors, especially in Europe and in Asia, that are always complaining, sometimes to me, that they don't get to see the VCs or the startups out of Silicon Valley. So what I hear very often is we never get to see those amazing startups. They can raise all the money in the US, so they never come to Europe, they never come to Asia to raise money, so we miss out on that. Well, now is an opportunity there. So now let me also say there have been some interesting development, and I'm happy for all those that want to reach out to me, use LinkedIn or whatever, to give you a little bit more color on it. But just one slide on that. So we've seen basically that some of the investors, sometimes family offices, experience one out of the US, create kind of mezzanine-like structures that do a couple of things for investors. Number one, they basically create a pool of collateral that protects the investor on the downside, but on the other hand, gives the investor equity participation on the upside. So that may actually mean that on the downside, if as long you break even, as long as your investment in that startup underperforms by up to 0.25x on the downside. So you still break even. So you have a little bit of a buffer on the downside, but then on the upside, you may actually get, because of PIK structures and so on, and the definitions for the collateral pool, you may actually get multiples on the upside. And the entrepreneur stays in the company. So I'm just basically mentioning that as one of the interesting kind of structures that we're seeing that may actually serve the entrepreneurs and all early hires in the startup, and serve the LPs that would like to get access to some of those structures. So on this note, I'm gonna stop here now. I could keep going, but I'm gonna now unshare, and then I saw, Philip, we've got questions coming in, and we already have a huge list of questions that
We
were
got
submitted
plenty. We got plenty of
beforehand.
things to get through. So, Claudia, I mean, that's amazing, and thank you very much for sharing.
Okay.
If I may, though, because I think there were a lot of solutions there and a lot of things that you highlighted, especially in the secondaries. But if we can just take a step back, I mean, we're seeing, as we mentioned, record highs. If you were to look at the public news that's coming out, everything seems to be positive in terms of growth, albeit there's a lot of kind of challenges and negativity and concerns and red flags. What is the disconnect with the private capital marketplace and the public market environment that we're currently seeing? And specifically, is it a structural issue or a cyclical issue that we're currently facing in terms of the exit paradox that we're talking about?
So to me, structural means kind of permanent. So the answer to that question is no, it's not. And I mean, having seen that industry over 30 years, we've seen times like this before. Okay. Now, obviously, investor memory decays in power law fashion. So we forget about that. Right now, maybe a comment on that flywheel, right? I mean, the primary markets are, whether it's venture, growth equity, or buyouts, ultimately are very much contingent on providing liquidity back to the LPs so the LPs can re-up or reallocate to future funds. That's kind of the unwritten rule. So you give me exits, you return capital. For me as an LP to maintain my allocation to private equity, I will then allocate to your next fund that's coming up. We have obviously seen for many reasons, right, that kind of flywheel got stuck on the exit side. IPO markets closed down. We saw basically more private capital raised, right? We saw also some of the private equity funds running a little bit into issues as interest rates started rising from 2020 onwards, right? So had to spend a little bit more time with their portfolio companies. So, and all this obviously delays then your exit, right? So then by the time obviously they come out, with IPO markets and funding basically being more expensive, some of the M&A activity dropped down as well. So some of the exit avenues, and we really only have a couple of exit avenues. It's either you sell to a trade buyer, you sell to you go IPO, you sell to another private equity or another venture capital fund, right? And in venture, there's basically late stage investors basically buy out the early stage investors. That's really the only liquidity that you can get in private markets. Now, with IPO markets frozen, M&A activity basically lower, and I'm talking until whatever 6 months ago, right? This has changed now a little bit. We see more IPO activity, hence a little bit more activity now, a bit more excitement on the M&A side. So the flywheel will start coming around again. Now, the question is obviously how long will it stay stuck? And let's also not forget, in the lead up, my chart, that 2021 chart with a peak up on top, in the lead up to that, we were raising very large funds, a lot of new funds, first time, second time funds, and so on. So there's a lot of dry powder. And that dry powder is aging. What does that mean? So usually if you've raised a fund, let's say in 2021, now it's 2025, you basically are 4 years into your 5-year investment period. If you have not at a minimum 75 to 80% deployed, your LPs will be really cranky. Why? Because it's opportunity cost for them. As you rightly said, they could have invested in this public markets, they could have leveraged themselves up with interest rates coming down and lived happily ever after. So you need to basically manage the expectations as well. So we need, number one, for funds to start deploying capital. There's no way they will raise future funds if dry powder remains high in earlier funds. So they need to start deploying capital. To be able to do that and justify it also towards the LPs, they also need to see exits. So we need this whole thing to basically come around again. A comment on public markets, and they're basically counter to a little bit. Yes, public markets have done very well, but as we also all know, this is basically contingent on a handful of stocks. Right. So overall markets, when you take them out, I would argue, depending on where you are in the world, have kind of like just performed sideways, right? Now, also keep in mind, because of so much dry powder in public markets, especially in venture, especially on the AI side, companies are just not looking to go public. Okay. So I think there is another conversation to be had about public markets, right? So will public markets remain relevant if companies just don't go public, right? So, but anyway, so that is opens another
I think
can of
that
worms.
obviously there's a lot to unpack there, but I think on one point that you're saying, we have short-term memory sometimes in general, but especially in this case, we've seen this before. So are there any learning lessons based on your experience of what are potentially macro triggers that could typically bring back the exit window, whether it's the IPO window, whether it's the M&A activity? I mean, obviously, we're tracking all of the regional data. We're seeing 100% increase in the total number of M&As here in the region. We've seen a record quarter of venture capital investment. So appetite is growing. And I've tended to believe that there's a lag to the public markets, which tend to be forward looking, and then private markets are the here and now and are impacted much more by the real economy versus the future economy. But in terms of specifically to your point, are there any macro triggers that people should be looking for to start seeing a return of IPO activity, a return of M&A activity, and appetite for exits?
Hmm. So I would watch interest rates. I would clearly watch M&A activity, which is, reasonably easy to do because right now investment banks get very excited about any M&A possibility coming up. So you will see that you want to watch M&A price level. So not just are there M&A, but also at what valuation are they happening. And then basically IPO is very much a sentiment play, right? It's a feel-good play. If the markets feel good, an IPO will go well. And what you need, again, you need kind of that happiness feeling for the next IPO to do well. So we need like one or two or three IPOs to do well. And I'm not talking about a 50, 100% pop on day one, just a well executed IPO with a little bit of pop on day one, but then with a consistent development of the share price. So that would go a long way. Obviously, macro wise, the world, a kind of like a peaceful world usually instills more confidence than anything else. So no more shocks, no more surprises out of whatever country with regards to trade and so on. Even though, by now the kind of various announcements on tariffs and whatever, I think people don't even pay attention to it anymore. I started seeing a lot of those things end up on page 2 of the news, so it's not a news and item anymore. So I think it's much more a sentiment part, right, for us to see that. And obviously, we need to see also those transactions to happen at good valuation, right? We can go back to that on continuation funds. How do you come up with a fair value for those transactions that change hands between the same GP, right? So all those things need to be done really at arm's length. So the investors are basically saying, okay, we're seeing this is kind of working again, so we're happy to re-up and come into the private market.
You talked a lot about the dry powder that's available, the fund structures, which are typically 7 to 8 years. And I looked at your data that you were highlighting the 2003 to 2022, the performance by the different asset classes. And one of the things that you were saying is that the dry powder needs to be deployed. One of the things that we've begun to hear more and more is of evergreen funds to basically combat the need for fund structures to be able to have a rolling kind of mandate. Do you think that's going to end up being a permanent change to either private equity or venture capital as an asset class in terms of the structure of the funds, or is that just a knee-jerk reaction to the lack of exits, and once the flywheel kicks in again, we'll go back to the fund structures that we've seen historically?
So clearly it is a reaction right now. Well, we have the capital, why do we, can we create a different structure around it? It's an interesting conversation, and ultimately, let's say that way, the LPs have the power there, right? Going forward, I'd like to believe that there, as an LP, you can choose between an evergreen vehicle and a straightforward GP/LP 10-year fund structure. And, money will talk. So we'll see where the funds will flow. Nevertheless, on the evergreen side, let me add on another part that was not part of my slides, is the rise of the idea of the democratization of private capital. So what's meant by that is, can we give high net worth individuals, not so high net worth individuals, and retail investors access to this asset class? So there, then basically you will find very much in the same sentence with evergreen, very often we hear that part of semi-liquid. Okay. Now, to be honest, I don't like the term because I think semi-liquid is a little bit liquidity is a bit like being pregnant. You either are or you're not. Okay. So, and semi-liquid can be quite misleading. Nevertheless, to attract those retail type investors, quite a lot of permanent vehicles are being set up that give those retail investors at regular intervals access to their funding. Okay. Now, usually they come with gates, they come with considerations, right? You can get your money out unless more than whatever 15% of investors in the fund want their money out, at which point we will basically restrict capital flow. So I think the development on the semi-liquid side, on the retail side, will to some extent drive the rise or the development of evergreen vehicles. Now, how many of those evergreen vehicles, how much money in there will be large institutional LPs? How much will be retail? Actually, it's also something that I'm watching quite carefully. And right now, it's too early. It's too early to see, right, how they're being allocated.
And you mentioned secondaries obviously extensively. I mean, how are LPs in the conversations that you're saying, you alluded to one or two conversations, looking at the backlog of kind of unliquidated assets? And are secondaries really the pressure release of this, or is it more of a warning sign to them that there's this call for the need of secondaries, and therefore their concern is the actual exits and the returns that they'll get from these investments?
So, I mean, let's be very clear. I mean, secondaries are still a very small fraction in terms of AUM of the primary market, right? So we have a tremendous amount of headroom. Let me also say secondaries are not new. Okay, so we've had secondaries probably since the mid 90s, right? Some entities would argue earlier, but I would say since the mid 90s. In the beginning, I mean, everyone is clear. You need a primary market first before you can have a secondary market. So we had to grow basically the primary market. I would argue that disregarding the need for liquidity, the fact that the primary markets have literally exploded in the last 15 years, it was just a matter of time until we saw more secondary vehicles. And I also saw an interesting question early on coming in with regards to who are actually those buyers of secondaries. Again, let's be very clear. All the big institutional investors, the Canadian pension plans, the Singaporean sovereign wealth funds, and so on, the endowment funds, they have had secondary teams trading secondary stakes for, I would say, at least 15 years. Okay, so again, there have been transactions going on. Nevertheless, I think nowadays, especially with more interest in kind of getting into vehicles that have a faster path to liquidity, you will see, which again makes it attractive for retail investors if you want to follow that conversation through, right? So a secondary vehicle is much more appealing to a retail type investor than a 10-year fund, right? And there's no doubt in my mind. Liquidity is, you will appreciate it when it's gone. So that's basically how it happens. And retail investors are usually not that good at assessing their own need for liquidity. Right. So we will basically, to me, this is kind of like it's a natural development. Nevertheless, there's always a but in my classes, as my students always point out. So there's always a point, and then she has an exception to it. The need for liquidity has kind of supercharged the development in secondaries. And I've seen this. I mean, I have every 4 to 6 months, I have some secondary GPs in my class, and they were always positive about for probably the last 12 years. So they have always been positive about their space, right? But in the last 3 years, they're just super positive. And I mean, just the data that they're showing for their own funds for different GPs is quite impressive, I have to say. So I think secondaries would have grown, doesn't matter how, because also don't forget, the more you see players investing in primary funds, the more they start asking themselves, why can I not manage my portfolio like I do on the public equity side? Why do I need to hang out for 10 years in there? And sometimes I may just want to reallocate, divest from the US, reallocate to Europe, and so on. So it makes it just, secondaries are a great tool for simply portfolio management. So it was just a matter of time, but the need for liquidity has just supercharged it now.
I'm going to come on to a question. So there is the Q&A. Please send them through, and I'll come to many of those in a second. This is a question that came through prior to the webinar, and I'm going to read it word for word because I think it's pretty provocative, but I think it's an interesting one around secondaries. While recognizing the interest in having a robust secondary market for private equity, How does one make sure that these secondary markets do not become like a Ponzi scheme where the last one to get the buck loses?
Absolutely. So now here's the good news and there's the bad news. So the good news is that secondary vehicles, whether they're continuation vehicles or whether they're just secondary funds, are usually not blind pools. Okay. So you basically have pools that already have assets in it. So obviously not every LP may have access to the quality or the information on all those assets, but you can basically see what kind of assets have been put into the secondary SPV. Okay, number one. Number two, there are funds out there that have track record, right? They didn't just start doing secondaries yesterday. So again, looking at past performance, how did they get access? Did they get access to quality assets? Or did they just create like a random walk kind of scenario? So I think doing due diligence on your fund manager is key. If it's a single asset continuation vehicle, then doing diligence on the actual asset and asking the right questions. For example, what is the motivation of the GP that continues to run that continuation vehicle? Is the GP rolling its carry into the continuation vehicle? That means, does the GP remain, as we call it, at risk by going into the continuation vehicle? How is the GP incentivized? I'm a firm believer in incentive structures. What are the incentive structures in your secondary fund? Okay. And those are things that, I mean, I would argue every pitch deck should have that. Certainly, your fund documentation will have that, right? So I think there are ways where you can protect yourself from that. Will we see continuation vehicles, for example, that will not do well? Of course we will. And here's the reason. So continuation vehicles very often have a single asset or just two assets in them. So by definition, they're not diversified, right? This is not a primary fund that has 15 assets invested in it. So you have a very concentrated exposure. So quality of the GP, quality of the asset that he or she chooses will basically be paramount, right? And again, I mean, we can do that same webinar again in 5 years' time and we can look back. And there will be the usual, the good, the bad, and the ugly. So that's just, I've no doubt that it will not be all smooth sailing. But I would basically go with, stick to your guns, due diligence, ask the right questions, ensure incentive structures are aligned with the LPs, and then basically there's no reason why not to be exposed to secondaries.
I'm going to just ask one final question from my perspective. Obviously, we focus on emerging markets. You're based in Singapore. I'm here in the Middle East. There's a growing appetite for venture private equity, private credit, and private capital across the board. I just released our Q3 report yesterday, and one of the things that we saw was more capital investment, specifically in venture capital in the Middle East and Southeast Asia. And from all the conversations I've had with the Southeast Asian ecosystem, which is more mature in terms of venture investment and it's been around longer. You could say it's been 10 years here in the Middle East and maybe 15 to 17 years in Singapore, is that exits is the biggest problem for the ecosystem, whereas maybe here it is, but it's not as acute. Are there any opportunities that you see from your conversations, both here and there, that people could think of in the coming 12 to 18 months to help accelerate exits from the emerging markets versus the developed world? Is there a nuance that we can have greater opportunities of collaboration, acquisitions, listings that are more regional versus global listings that can bring that flywheel back to benefit governments, investors, founders, and the wider market?
So, I mean, look, in emerging markets in general, right? I would say for the last decade, the biggest question that I was always asked from LPs was, Claudia, are we ever gonna actually see some money back? Or is it just valuations are being written up? Okay, so I think GPs have to just realize if you're raising a 10-year fund, you are expected to return money within the 10 years plus the extension. Okay, wherever you are in the world, right? Maybe there, I mean, there's an argument then to be made. Maybe it cannot be done in 10 years. Okay, then let's raise 15-year funds, which obviously will make it very complicated. Not many LPs want to jump into a 15-year fund, even though the reality in VC is probably much closer to 15 than to 10 years. So when it comes to liquidity. Now, what will help, obviously, is again the future investors to come in and see the opportunity, whether those are the corporates, whether those are growth equity vehicles that basically have a look at this. So the ecosystem just has to basically play ball. What obviously helps as well, depending on where we look at emerging markets, right? Anywhere in the world, we need to open all the channels, right? So creating a good public market, an IPO platform that allows younger, smaller companies to go public is fantastic, right? So, and I think there's headroom both in Asia, Southeast Asia, as well as in the Middle East, as well as in Latin America, right? So we don't have to send those startups or those scale ups to the Nasdaq. Right. We need basically those avenues. Again, think of the exit avenues. How can you make that attractive? Right.
Yeah.
Maybe there's an argument to be made that some of and I've had yesterday a conversation with a venture builder here in Asia, and they're saying, like, look, we're trying just to build a lot more with large corporates because we really want to build something that solves a problem for them rather than just a broad, basically market problem potentially. So again, that basically would be my suggestion. But I agree with you. Yeah, the Middle East right now has a very different energy feel, right, to it. Nevertheless, I mean, to be fair as well, most of the funds playing in the Middle East are much earlier stage, right?
Yeah.
So you don't have many firms that are in fund 3 or 4 or later. Right. So it's much earlier days. But I think for the Middle East, it would be kind of like a good lesson to keep an eye on what's going on in Southeast Asia, because it's
Absolutely.
likely to be about, what do we call it,
Yes.
a decade ahead, right?
Yeah.
So, I mean, just be aware as a GP, your LPs may have patience, but at one point that patience will run out,
Yeah.
okay? And they will
I
then go for greener pastures.
cannot echo that enough, and I've been saying that Southeast Asia, which is why we cover Southeast Asia to on Magnet, is because it's great looking at the US and Europe, but actually it's a more relevant market in terms of comparables. Look, I'm going to go to some of the questions that we have. I ask if it's possible, we'll do shorter answers to try and get through as many of them as possible. Given the high amount of dry powder in the industry, with big players raising record funds and the FOMO around AI, do you see PEVCs overpaying in AI companies? A repetition of what we saw back in 2021 and 22, but more concentration around AI.
Yes. You
Great.
wanted a short answer. So they
Perfect.
absolutely. FOMO is a thing in financial markets. The longer the FOMO goes, the bigger the correction will be. Not only in 2021, I saw that in 1997, 98, the frustration with it, the Nasdaq crashing 70% in 2020, 2021, sorry, 2000, 2001. And at that point, then we had 10 years of basically no VC. And I'm saying no VC, I'm exaggerating. There was VC, but obviously it made a very small percentage allocation of portfolios. I hope we're not going to get there, but right now it smells a bit like it. Yeah.
Given that private companies are staying private longer and achieving greater scale, is the pool of viable M&A acquirers shrinking? And what indicators suggest whether strategic buyers or financial sponsors can still provide meaningful exit liquidity at possibly elevated valuations?
That's an interesting question. I was just looking into that, and I haven't gotten to the end of that yet. But in principle, yes, that's a sound argument. But I would also argue that, I mean, look at what's going on, particularly in the AI space right now. We have basically M&A happening from companies that only started raising funding 3 years ago. Okay. So you don't have to be, I don't know how to say that. You don't have to be a grown up to do M&A, right? I mean, you can go out and say, hey, dear, I don't know, Sequoia, Silver Lake, I want to raise money because I want to become the biggest fish in the same pond, right? And you don't have to be a large corporate to acquire some of your kind of peers in the same space. I would actually expect for that to happen in AI in the next 2 years quite a bit.
I'm going to ask, there's a question here. You've touched on parts of this. On the liquidity paradox, do you see any differences in activity and attitudes across geographies, US, Europe, Asia, Middle East? And I'm going to add to that something that you touched on in your presentation. Peace times are better for economic deals and M&A. Have we had challenges? Have you seen in either Asia or the Middle East challenges with regards to the geopolitics, with regards to M&A activity, or do those M&A acquirers go beyond the news?
Um, yeah, it's an interesting question. I don't know how to answer that like in a thoughtful and short fashion. So, I mean, around there are differences back to the original question. There are differences around the world, just simply in terms of maturity, right? I mean, we've seen, and it goes from the US to Europe to the rest of the world, or to Asia, and then Middle East, Latin America, the emerging markets, right? Um, and again, when it comes to secondaries around the world, of course, those regions that have the largest primary market have the largest liquidity for secondaries as well. Therefore, if you basically are looking for liquidity, even as an LP, out of a smaller fund in Asia, I think it will be much more complicated unless that fund, when it was raised originally as a primary fund, was well oversubscribed, right? And there are plenty of LPs that wish they could have gotten a larger allocation for it. So I don't think there is. It's very much a local story as you go around the world. But yes, absolutely, global M&A, you will see that, you will continue to see that, and we've seen this already now. We've seen, for example, quite a few Middle Eastern entities actually being very brave and going where none of the Americans and Europeans want to go. For example, China, right? For example, real estate in China. So again, some Southeast Asian entities have done kind of interesting deals in spaces that were not that close to their home where they're usually playing. So I think the global investment part is very much alive and well. Yeah, and will develop.
Interesting question here on the operational side. What drives the performance of a secondary buyer? They buy cheap or are they creating value of the assets? And actually, just interesting for myself, how much value add do they come in versus a primary investor into an asset once they've done a secondary?
Okay, so we gotta be careful here. As a secondary fund, buying into whatever GP-led or LP-led opportunities, you are basically backing the existing GP, the existing owner, right? So there's basically your role is much more to assess the quality of the existing GP, because they will be the ones that will continue to basically drive the asset. You're not the owner of that asset, right? Now, if you're buying a single asset as, let's say, an LP that is willing to do direct deals as well, you're buying a single asset, then very much, yes, that's a conversation. I mean, and there you should be very clear as a buyer. Are you a pure financial investor? As many of the large, let's say, pension plans are, they're saying, we're doing direct, we're doing a secondary transaction, happy to do that, but we're a pure financial investor. So if there is a need for operational value creation, we may come in, but we may bring in another GP who comes with an operational value creation team, right? That then adds value to it. So it's really difficult to generalize here because, again, the secondary buyers come in all shapes and colors. So it's very much a kind of like deal by deal conversation. to be had. But again, very clear, the secondary funds do not basically go close to the asset, right? They back the GP.
We saw here in the region a company, Property Finder, that raised venture debt or credit to buy back original investors as an opportunity for an exit to one of the funds that had invested in early stages. Are you seeing, especially as companies, in their case, doing extremely well, moving into positive kind of profitability as a company, companies that are staying private for longer and not needing the need for the exit at the IPO level? Are you seeing more companies using debt as a facility to buy out existing investors to create liquidity for the early stage investors?
Absolutely. So private debt is, well, depending on where you go in the world, it is, I would say, in general, alive and well, with the exception of the US. So I think US private debt right now, people will have heard about First Brands. It's something to watch. Now, private debt is a super diverse market. So it's very different whether you're talking private debt in Europe, even private debt in the US. So in the US, it's very driven by leveraged buyouts, by meaning sponsored debt. Whilst in Europe, it's at most 50% driven by leveraged buyout. The rest is driven by demand from corporates, right? The Middle East is still, and Asia as well, we're still working on which way it's going. So it's really, really early days. But absolutely, I mean, there is a huge amount of interest, which is kind of to me interesting because I think the reason why there's interest in private debt from LPs to some extent is because number one, the moment you invest in a debt vehicle, obviously you're not taking the first loss as you do as an equity owner. Okay. And in addition, if your private equity is already heavily exposed and you already have tons of dry powder, well, why not take a little bit of safety, take a lower return, but also a lower risk by going into private debt, right? So there's that conversation. And then for your neck of the woods in the Middle East, from what I just heard recently, quite a lot of the banks are really kind of tapping out in terms of their capacity. So usually, keep it simple. I mean, the regulators will give banks a certain headroom, how much debt they are allowed to kind of give to small and medium enterprises or large enterprises. And because of economic activity, that headroom is almost gone, right? So obviously corporates are saying, hey, you can't give us debt anymore. Where can we go? So there could actually be quite a bit of opportunity. By the way, it's a similar story to some extent across Asia, right? Where we're seeing kind of like real demand for private debt coming in. So absolutely, I can see this. I've seen already GPs moving to Asia, setting up teams here for debt. You will see the same in the Middle East.
But just to double click on the question is like as a use case for buying out early stage investors rather than just debt. And are you seeing that as a tool to buy out the liquidity problem for early stage investors?
To some extent, yes. I mean, if it's early stage, if that early stage asset has liquidity, has already a P&L, right? So, I mean, I'm a firm believer that, to justify debt, you need to be able to service the debt, which comes with cash flow, right? So, and when it comes to debt, cash is not only king, cash is the only thing. That's all that matters. So again, I think it depends on where we're talking on the spectrum. We're not talking around A and B, but later stage startups, yes, absolutely. I see that possible.
Last question, as we have 2 minutes left, and I want to use all of the time that we have available. If you were starting a PE fund in emerging markets today, where would you see as a region or country with the most potential?
The region with the most potential that has not been tapped yet is for sure Africa. I'm a
Yeah.
big believer in demographics. It is the youngest place on the planet. It has a need for financing. Of course, initially real risk financing. We're talking venture and then growth. I mean, I'm not gonna go into Africa with a leveraged buyout fund. That would not be wise right now. But right now, I would certainly pay attention to Africa. Africa is at a tipping point right now. And that also means for anyone in the Middle East to really pay attention to a continent that's very close to home for you and to keep an eye on the opportunities there.
Claudia, as ever, an absolute pleasure. Thank you very much for all of your insights. I look forward to seeing you very soon here in the and thank you very much, INSEAD, for hosting us today. And I hope that was insightful. Could probably go on for many more hours on each of the different subjects. But I think that was a very eloquent overview of what's happening in this space. And I'd love to do it in 5 years' time and reflect back, if not sooner.
Let's do it. We'll put it
Thank
in the
you very much.
calendar. We'll come back in 5 years' time. I'm sure some of our alumni will remind us of that as well. So it's time for Claudia's review. So maybe we should do it every year. So we kind of like sneak up on the 5 year part. Thank you
I'll
everyone
do
for the
that as well.
questions. And
Thank
I'm
you.
I'm sorry we couldn't address more of them. And thanks to the lifelong learning team.
Thank you.